feels like many of these tech companies, it's a mass orgy, if I can put it that way. I'm not pumping on YouTube. Hey guys, you guys are stupid for not buying into Baba. I'm not saying that. I'm just telling you guys my entire investment journey. I buy into Baba. This is my thesis. You want to attack the thesis, can. Welcome back to another episode of the Backholder Pod. So I think back by popular demand, there are a lot of people that say that there's a lot of questions that they want to ask, and this is probably a part 2 of the discussion around the entire investing in China discussion previously. That there wasn't a lot of views, but I think it's relatively higher than our average views. And the comment section below actually did talk about, they like discussion points, or they think that I was triggered and stuff like that. I think maybe just to put a disclaimer out there, we are still fine. I'm still good friends with Bunti. I think it's just the nature of our discussion. We get passionate about our discussion, and then we cut in and out, and yeah, there are certain remarks that are thrown here and there. But to be very, very honest, we are in this game, or at least I'm in this game for more than 2 years now on social media. I've gotten worse comments compared to what Bunti said. So I did make a point in the comments below. I was more exasperated than triggered, because I went back to relook at the video again, and then I realized that we are not really talking on the same wavelengths, in a way where post discussion, when Bunti made clarifications on his point, I get where it's coming from, and then when I look back at my response, it was clearly not answering his question. So we are basically talking over each other, which was why the point wasn't really made very clear. So yeah, back by popular demand, since the other time there wasn't really a moderator, Eric has joyfully volunteered himself as to be the moderator for this time around. And yeah, we can go back to some of the discussion points that wasn't well answered previously. I'll pass the time over to either Eric or Bunti if you have anything.
Bunti, do you have your first question to ask?
Yeah, actually, let's follow up. I think since the discussion that we had last week, right? Now then we have this news coming up say that Ants just got fined by the government, and then it seems that the positive view of it is that things are moving on the right direction. They just want to close up whatever rectifications in the past. The share price of Alibaba also reacted positively. Right? I think Chicken also made a good video on these topics. But just want to get a sense of the sentiment now. What do you feel about this entire situations? Do you think that it's really that the rectifications is over, and then now we all can start to prepare the boat to leave the port now?
I think short answer, because I realized that the other time the explanations are very, very long, lengthy. That's why the discussions get messed up. But to answer your point, generally, this is my perspective. Everything that I'm going to share, disclaimer, everything that I'm going to share is my perspective. It doesn't mean anything. Facts are there. Whether the data is manipulated or not, we can discuss it another time. But my understanding, many investors that used to invest in Chinese stocks are tired. They are anxious. They don't know what to do, and many people have already left the boat. Like not the boat leaving the port, but people leaving the boat. Like they just sell out, and enough is enough. They're scarred and whatever. I think my entire thesis did predicate on things reverting to normal, meaning the lockdown will end, the regulations will come to an end, things will go back to normal, business as usual. So that was my initial reaction, or my initial thesis into investing into them in the first place. Margins will probably revert back up, earnings will come back, and companies can expand again. I mean, that's my theory. Whether it will play or not, I'm still waiting. I've been waiting for 2 years, waiting for another 2 more years. I don't think it's very hard. So yeah.
So my question to you would be, right, how long do you intend to wait for the mean reversion?
How long I intend to wait? I don't know how to answer a question. What do you mean by how long? It's like I think if I flip the question, right, how long will you wait for Tesla to finish full self-driving? Do you have an answer? This is a side question.
Roughly about 2 weeks.
So 2 weeks later, if they don't solve FSD, you sell the stock?
2 weeks.
Oh,
Elon's 2 weeks is like 2 decades.
Yeah, so I think, but I get the essence of your question, meaning how long are you going to backhold? If things don't turn for the better, what's going to happen and stuff like that. I won't put on an arbitrary timeline on the stock or when it will perform. But I think based on the news developments recently, it's true that we are seeing definite signs from the main authority, what the government is talking about, what the regulators are doing, and stuff like that. So I think from here on, at least we give them a few quarters to see whether they can bring back earnings, cash flows, and stuff like that. If not, if they continue to underperform, while at the same time, when I look at their competitors, that they continuously outperform, then I guess there is a sign of telling you that, hey, this company, it's a company specific problem, not really a macro specific one. So yeah, I hope I
Okay,
answer.
so in terms of the financials, right? I think you have a good pulse on things. How is their financials looking like? And roughly, right, like how many quarters would you monitor to kind of determine like what you say, right? It's time to move on. Like, for example, you can say that, okay, if I monitor for 2 quarters, right, continuous decline or stagnation vis-a-vis their competitors, then I will move on. So that translates to about half a year, right? So how many quarters roughly would you need to see like a not so good financial statements, then you decide to move on?
Before Chicken answer these questions, I also think that we need to frame our questions better in a sense of there's better clarity on what are we discussing about, because there are two things that are different, right? First is Alibaba versus like general China stock market. The other one is that because if we choose either one, right, it'll be very different discussion, because I'm the one that set up the first questions that I talk about, this NPay, then suddenly we are into this Alibaba. So is this all continue to be about Alibaba, or do we want to, switch back to like just talking China stock market in general? And then the text messages in the group, right, from Mr. Lu is also about China general, right? So I think we need to get clear on that first.
I think my question, right, to reframe it properly, I was asking Chiking about Alibaba. Okay, because there is no China financial like overall. Like how can I ask Chiking to qualify this? There's no like one source that captures everything. But Alibaba, I can ask him to qualify. I said, hey, so if like 2 quarters of bad CFC or some what FCF free cash flow.
Yeah.
Yeah,
I think
so if he sees that, then maybe he sees negative free cash flow for 2 quarters, maybe he decide to cut. So something like that, if he can just let us know, like, okay, what is the parameters that he's looking at, what he's looking out for, so that if he sees this, it will be a line in the sand.
I understand. If I can revert back, right? I think just to further add some color to the context as well. I think a lot of people think that when I'm talking about investing in China, I'm asking you to buy the ETF. I think it explains more when you look at the person's actions rather than what he or she says. So it's true that I'm rather bullish on China, but evidently I'm not bullish on the entire Chinese stock market because I don't buy broad-based indexes. I'm stock picking. So that's just some color. Even in a down, like in a bear market or in a huge bear drawdown, there are still pockets of stocks that might or might not outperform. And in this case, I do see many of the Chinese tech counterparts having the ability to outperform. That's the first point. On the second point, back to what Eric is talking about, in terms for in order for a stock to outperform, right, there are many ways. So one is growing free cash flow, growing whatever EPS, and then the stock price, markets are correcting their mistake, and then the share price come up. I think the other part that people often forget is sometimes it just takes a company that everybody expects to be extremely, extremely shit, and they just don't be too shit, and then boom, the price will revert because it's just an expectations reality mismatch. So I think Alibaba or many of these Chinese tech companies actually do fall into the second category, where people are pricing in a lot of crazy stuff, whether Alibaba is going to stay flat or Alibaba is going to start going down in revenue and stuff. And then that's how they price the stock today. So that's the second point. And on the last point, to circle back to answer Eric's question, right? I don't really have a specific set of metrics that I look at, but to also provide some understanding, at least in the e-commerce space specifically, JD and Baba hasn't been doing very well, while Pinduoduo, on the other hand, is doing extremely, extremely well. Like, by extremely well, they're growing like 40-50%, I think the last earnings report, while Baba and JD is single digit. The main discussion around it is really because when purse string tightens, when the economy is bad, people tend to go for the cheaper option or cheaper alternative. And we see it being true in many major economies. I think in the US, there's the discussion about how Dollar General stores are doing better compared to many of their counterparts. But I do believe that this is part of a larger macro cycle. I do believe that people will continue shopping at the higher end and people are going to continue spending money, but that is only when the optimism kicks in again. So this is the first point. I think the second point is you talk about whether they have negative free cash flow and stuff. The funny thing is, even though growth has been slowing down but they've been optimizing their cost structure and whatnot. So that's why free cash flow and the earnings or at least margins are improving. Free cash flow is going back up again. But if you look at the trend, it's an exponential increase. 2022 was a huge fall, and then they're slowly going back up again. So whether is this trend moving in the right direction or not, I mean, I'm kind of hoping that it continues going up. But you want me to set a perimeter that, if 2 months time, or 2 quarters time, the free cash flow go down. I think you need to take most data points into consideration. At least for now, I do believe that we are coming. The retail sales are going to come up. Optimism is going to kick back in. Consumer sentiments are going to improve. But if I really waited for so long and I'm going to sell now and say that, just because there is some sort of turning here and I'm not going to wait any longer, I think it's quite funny as well. Because if not, I would have stayed out and just wait for this whole thing to go by and then I'll come back in. I mean, if that was my logic to begin with, but it was not. My logic back then was, I know things are going to end. Something somehow going to give. Everything is going to come back to normal again. And that was my initial thesis when I entered. Yeah, I hope. See, it's always a very lengthy response. I hope I get to answer a question.
So I got a follow-up question. Why specifically China stocks or even like Alibaba? Why not let's say Japan? Japan recently hit their market hit back an all-time high. Why not US stocks where there's more data points? Data points meaning there are more people covering it. There are more opinions, less government risk. This kind of stuff lah. So like why exactly is so interesting about China?
I get what you mean. I do agree, by the way, that there are pockets of opportunities in every single market. Even in the US, right? I recently saw an interview by, I forgot what's his name, one of the famous hedge fund managers. He was saying that right now, value stocks in the US and small cap, micro cap stocks, the Russell 2000, the deviation is at least 2 SD away, 2 standard deviation away. So actually, there is still value to be sought in all sorts of markets, even US small caps. Japan, yes. I think if you manage to catch it together with Buffett during last few years, you also increase by a lot. I think I just wanted to prove the point that there is value everywhere as long as you seek it. Why I specifically go into Chinese stocks, it's just, I guess fate brought us together. I happened to follow the market and there was this huge drawdown and there was a lot of narrative building around them. And I went in to study a little bit more and then I saw value. I bought into value. Simple as that. You tell me that you want to buy into Russell 2000 now. I think so be it. I also see value there. It's just that, I mean, I have been studying that particular pocket of the market for so long now, and I haven't really seen the reversion yet. Could it be like Japan, 30-year lost decade? Sure. But at the end of the day, at least my underlying philosophy or underlying theories, we will revert back to the mean. I mean, it's a mechanism of the market. So yeah.
Yeah, definitely from valuation perspective, hard to argue, especially companies like Alibaba. If you minus out all their cash that they're able to distribute out, right? Say, for example, if they do a massive share buyback, the market cap can shrink significantly. But the outstanding shares also can shrink. So you can actually bring up the earning per shares or free cash flow per share. Any metrics that you want to measure, you can look at the pretty picture. And just looking at the PE is very low after you do this adjustment. But I think specifically on Alibaba is that I think the competitions with Pinduoduo and JD, now with ByteDance, I think all these competitions is really, really crazy. They are having all these, price card just to grab market shares. Everyone do the same things, right? Eventually, you need 1 or 2 players that go under. Then the remaining 2 more players can, get the benefits because they know that, okay, at a certain point, we have to stop the bleeding and then just focus on the profitability. I haven't seen that happening, given that recently there's a few rounds of price cut be it in Alibaba Cloud and then in e-commerce, JD also do all this crazy stuff. So that let me questions like, for Chinese companies, is it that they are really crazy when it comes to competitions, meaning that nobody want to back up from the game? I give you one examples. I think in the previous episodes we talked about NVIDIA, and then we discussed about, okay, NVIDIA suddenly go and do all this CUDA thing, do all AI chip and so on. But just before that, right, that was I think 10 or 15 years ago, it's long time ago. They actually realized that this entire graphic card industry is so competitive that they don't want to be in there. So they spend R&D, they do something else. They go and build this CUDA thing for 10 years, keep on doing AI stuff before this AI is a new stuff. It's an important things, right? So they really like avoid the competitions. I think this is what I will, something that I focus on for companies that, branch out. Instead of like keep on just compete and then let the margins go to zero, they do something else. And NVIDIA is not only one. For example, another company, Chinese company, Meituan. Actually, when Wang Xing set up the companies, right, he's also very clear in terms of the direction. He said he is not going into e-commerce. Although at that point, right, e-commerce is still the the industry that is growing. He said, I can't go into e-commerce. Why? Because Alibaba is there and Alibaba is very, very strong. So he purposely get away from e-commerce and do more of these like local services, offline, online things. But what happens is that in that areas, they are the best now. They are the biggest. They are the most successful one. And they purposely avoid Alibaba. Now come back to Alibaba and JD, you can group all these Pinduoduo. The reason I don't have all this investment in this company is because they all like still compete with each other like crazy. Is that a concern, or do you foresee that these things will stop soon, or what's your take on this?
I think the funny thing is you started the question saying that are all Chinese companies like that, and then you provided a Meituan example, which is also a Chinese company.
Okay, maybe
So
not all. I would say
Okay.
specifically e-commerce.
lah. Okay.
E-commerce, I see this and this is my concerns. Yeah.
Understand. I do agree to a large extent because those are facts. Those are factual data. You can't run away from growth rates, from margins. You see things getting compressed, right? But at the end of the day, specifically for e-commerce, just also background, I also have other companies like Tencent, for example. It feels like many of these tech companies, it's a mass orgy, if I can put it that way. They always like to be the biggest, the strongest, create the best ecosystem in their platform. And like what Meituan is doing, they are first. But coming in at the close second is actually Baba, which with their new platform ads and whatever that goes into delivery, goes into the food, the ride hailing, whatever, they are also in that space. So then begs the question on what's going to happen at the end of the day. I do believe that over the last decade or so, when Baba was having the exponential growth, it's accrual to shareholders. You can see cash flow coming in, you can see earnings, you can see things that are benefiting at the end of the day, at the bottom line. So all these price cuts, competition, whatever they are doing, I do believe that it's not sustainable in the very long run. We all know that. And we look at what is happening in Southeast Asia. I think Shopee and Lazada is also having at each other's neck. And then we know that when a downturn came, both of them started increasing their take rate, their merchant fees, whatever. So it feels like at the end of the day, now, at least when they're in the competing phase, everybody's burning cash. But at least a few years out after they've consolidated their position, they will all go back to normalcy again, which is reversion back to the mean again, where everybody has to rely on each other's platform and they can't kind of escape from that. That's just the economics of the industry. So that's just my perspective. Will I be wrong? Probably, because when we look at Uber, when we look at Lyft, they're still competing at it. They're still the numbers still don't look great. But I do believe that at least there is precedence, or there is actually the last 10 years of history that shows that they can be highly profitable and they can be accrual to shareholders' interests. So, but now we are in that specific time period that all the numbers just looks like shit, basically, if I can put it that way.
Yeah, because I'm trying to look for evidence of all this. We see sign of these things, and not just like, okay, I think things will normalize and then it will normalize. I'm looking for like evidence. The reason I say so is because for companies like this, right? Say for example, JD and Alibaba, they keep on like kill their own margin in order to compete for market share. Let's say one of them need to like slow down, right? they have to go somewhere. They for example, like Nvidia, they get out from their focus and focus on something else. They need to have something else to show for, you know. They cannot say that, okay, this is too competitive, I get out, then I'm not doing anything else. What it means is that you basically just say that there's no more growth story. It's hard to, you basically just kill yourself that way. So come back to JD and Alibaba. I'm thinking that between these two, will any one of them actually back down? Hard to see that because both are very, very strong. JD also very strong. Alibaba same.
I think
So why would they actually like just, you know, like I stop competing?
Yeah, I think Baba tried. Baba, that's why they're going into they're going to go into fight Meituan. They're going to fight cloud computing. At least the growth story there hasn't been playing out. That's why the share price is taking a beating. There is no narrative to build because it doesn't show in the numbers. Because if you want to tell a good story, at least you need some financials to back it up. But as of now, it doesn't show. And we will see. I mean, it's also quite unfair to compare JD into the picture because they are of very different scale, reach, magnitude. But I think generally that's why I'm invested in Baba but not JD. I'm not very hopeful that e-commerce is the way to go. That's the golden ticket to get all your margins and get all your money. Because even likewise for Amazon, the commerce business is not a very, very good business to be in. Margins are razor thin. Customers keep complaining, and you just keep building and building and building. They can build a few FedExes over the years, but it doesn't really matter if you can't convert it into cash flow. So that's why they're all branching out, or at least for Baba's case, they're branching out into many different other segments that are growing steadily, but they still have nothing much to show because it's not profitable. They haven't do it. But I think I also wanted to put in another contender because we've been focusing on Baba because you guys know that I'm the biggest Baba bull, right? But there is also another company that is doing whatever they're doing, which is Tencent as well. So Tencent's margin has been going down as well. Like during the lockdown, advertising, whatever, you just look at the numbers, it's all the whole piece of red financials. But same story as Baba. Now margins are slowly to improve again. It's not as suppressed. Revenue growth is coming in, and you see that they are trying to pivot away in terms of just focusing on their core businesses like gaming and stuff. They're also trying to pivot because maybe the CCP doesn't like. I don't know. These are just speculations people throw out. CCP don't like people to game anymore or whatnot. So now they're also trying to build up the entire platform economy and ecosystem that they're doing. So I think likewise, many of these tech companies that have already made their name, that's all they're doing. And at the same time, it's quite ironic because if you look at their free cash flow yield or whatever, what the market is pricing them today, they're easily going at like 7-8% yield. Baba is going at 11-12% free cash flow yield. If you less out the cash, it's even crazier, the number. The number just keeps looking crazier and crazier because the stock price keeps going down and down and down. So then that comes a point where if I'm thinking of it logically, if let's say I'm able, if the companies don't just cease to exist, meaning they just don't keep deteriorating until cease to exist, if they just hold their margin, hold their free cash flow margin, hold their profit margin, within 8 to 10 years, I'm going to get back the entire market cap. And that's without lessing off the cash. So even for Baba's case, if I less off the cash from the market cap, I can probably get back the entire company within, I don't know, 6-7 years, if assuming that they return all the free cash flow to shareholders. So that's the kind of valuations you're talking about when compared to like your US counterparts or like your big tech that are doing exactly the same thing. But yes, they have bigger scale, they have bigger reach, but so are their valuations. A lot more bigger, a lot more expensive. And they're trading at a yield of like 2-3%. Baba's trading at a yield of like 10, 11, 12% before this rally. It's 6 times more expensive. So yeah, that's just my general understanding on this mean reversion and understanding valuation and the context of how things are playing out.
Yes, in terms of valuations, I think Bunti also said that, you know, if you revert to the mean, right, China stocks are looking very attractive. And the way they put it, I also understand where you're coming from because the valuation is so attractive. It doesn't make sense for you to like cut it and then go elsewhere. Like it's kind of silly, right? Just to move elsewhere. Yeah. So thanks for your
You mean in terms of portfolio allocation, right? As in selling out the stocks and moving it elsewhere.
Yeah. Because I think like the way that you put it, your view is that there's valuation is cheap lah. There's like places, different parts of the world where you have valuation that are also cheap. So the reason why you don't move to like say Japan or US, is because one day they will revert, ma.
If I can add on for that as well, I don't know whether you guys know another very famous value investor. I think in the YouTube space at least, it's called Monesh Pabrai. So he basically picks stocks, or he has been touting for a few multi-baggers that he has found in Turkey. So I'm not too sure how familiar you guys are with Turkey's market. But the interesting thing is this: when value or whatever investors, I don't want to use value investor because I don't even know what it means anymore. But when investors go to other places or cheap areas to find stocks, right? People never question about, oh, what is Turkey's politics today like? How is it doing? Because nobody gives a damn about what Turkey's government is gonna do. But when they think about the investment thesis, they think about how the business is accruing shareholders' interest, then they are solely focused on like the Turkey business, how they're improving their margins, how are they fighting high inflation, blah blah blah. So that's very business specific. But the interesting phenomenon that I observed is really when we talk about China, everything is about one man and one man only. I don't know why, but everybody they have an obsession with one guy and what he's been doing and how is it going to affect the businesses. But at the same time, when you look at many of these companies, they have stood through the test of time. They're listed for 20, 30, 40 years. There are many companies that enjoy great amount of returns. Then a lot of other financial gurus out there, they just like to pull out the China index. Oh, look at the China index. It's been down for how many, whatever years. The Singapore index is the same. That's why I'm not encouraging you to put all your money into like the STI or the CSI 300 or whatnot. This is different. Like many of these index makeups are fundamentally different from the S&P 500. They have different rules, different maturity of the markets. If you're talking to me about stock picking, then we focus on the stock or we focus on the business. If not, the goalposts keep shifting, like people keep moving around and say that, oh, look at the index is so lousy. But then when I pull out companies like going up 20, 30,000%, oh, you won't be so lucky to pick out those companies. I mean, that's why we have to set the premise of the discussion right. Like to really have a very focused discussion and meaningful discussion in the first place.
Just to push back a little bit on you saying that investors don't really care about which country that we are looking at, right? I think the very moment you brought up the Turkey example, right? The first thing I thought of was their currency. That was literally the first thing.
I think not so for normal investors that are on YouTube. I mean, like when they go on to focus group discussions or like go for lectures, because a lot of all these hedge fund managers go for like finance related places like conferences or whatever. And people usually don't ask about what's the Turkey's president doing today, or like how is he gonna talk. Many of them just focus on the business fundamentals. I mean, I can share a link to when Monesh was talking about his Turkey investment. You can see that there is a difference in terms of how they're asking questions. Like the approach is different. I hope I could, but yes, I also do agree that when you ask me to invest in like, I don't know, Greece, I think Greece is also very cheap. Then everybody was thinking about the Greece bankrupt or how Greece is affecting the whole EU, right? So that was also my initial thought. But that's why we stopped digging. After we go the surface level and then we stop digging. And then we say, okay, this is a too hard pile. And I'm not saying that this is a bad thinking framework. I think this saves a lot of time. It provides a lot of convenience. But then at the same time, at least for those that kind of did their homework and people that are even remotely interested in those places, then there are probably further discussions to be made there.
Just to respond to Eric, that companies that Monish talked about, right, is companies that do export. So that's the things that Chicken tried to bring out, is that if you just look at the country, like the entire stock market, yes, the currency is an issue because there's so many companies in there that are not doing export. So as your currency just become devalued, there's all sorts of problems. But specifically, these companies that Monish invest in, they are doing export. So it doesn't matter how much Turkish lira drop, right? So they can still get the money for their export in USD terms, right? So that's why it's good for them. Actually, yeah. So that's the specific case now. But back to response to Chicken about this about one man, right? I think we all need to appreciate that actually, like countries like China are also quite unique in a way that the government, they operate like a central party and they decide the direction, and they can just be very forceful when it comes to implementations. They can close down the Chinese the private educations practically it's like overnight, right? It's just like everything's gone. You don't see these kind of things happening in other countries. At least there will be more, like people try to fight back, people try to get all sorts of things, try to lobby and so on. But in China, it's that you don't see that kind of things. It's like very fast, very quick. And then that's why people also scared, right? Because they think that, okay, even if things are going south, I can't sense it, I can't smell it, it will just be gone, So people just avoid that now. So it's just different appetite. People don't have that kind of appetite. I think it's up to them, right? Every countries have their own
Completely agree.
characteristics. Yeah.
Completely agree. But in terms of the smelling and knowing, etc., I think it doesn't pain you, for especially for people that invest a lot of money, to really follow what the government is doing. I mean, they have a 5-year plan, they have a 1-year plan every year. They have the different focuses that they're doing every year. So it's not a very, very long report. If you're lazy, you can read a summary on it. They focus on AI, focus on chips, focus on green energy and whatnot. Those are all set out in the plan itself. But I think also to the entire private tutoring thing, right? I'm not gonna like write a blank check to the CCP and say that, oh yes, this is the right way to govern it. I guess even like Temasek, for those of you who don't know, they are caught in it by a surprise. I don't know whether Temasek is scarred or not, but based on, I just Googled, they still have a 1/3 stake in China positions. So I don't believe they're scarred. They still believe that there is a lot of opportunities to kind of reap some sort of diversification benefits, equity premium from somewhere, somehow. If not, they would completely exit their Chinese position. So then I think I kind of wanted to answer some of the questions about, oh, it's so risky, you shouldn't put your money and whatnot. Then I think we all should write in to email Temasek or GIC that why are they risking so much of our money in 1/3 of the position in. But I think if I'm not wrong, don't quote me on that, but they have 1/3 in Singapore, 1/3 in China, 1/3 in US. So they are investing in the 2 biggest economies of the world today. They got burned. They definitely got burned in big tech, because I know they have Baba. Tencent, I don't know, but they have a Baba position. I know they bought into some of this TAL, Oriental, whatever, all these private tutoring industries as well. So it gives me that impression that, retail investors or whoever that bought into Alibaba, you guys are all bad. You guys don't know what you're doing. You're all risky. But then when Temasek does it, I guess it's fine. They have billions of dollars and it's a small exposure. It's fine. But I do honestly see that. I think in every certain any scenarios out there, there are definitely value, there are definitely opportunities. It's in the value is in the eyes of the beholder. You can see the value before the market. You will appreciate, or you will get to ride on that value. If not, if you think that it's a too hard pile, too risky for you, you don't understand, then don't touch it. Nobody's. I'm not pumping on YouTube. Hey guys, you guys are stupid for not buying into Baba. I'm not saying that. I'm just telling you guys my entire investment journey. I buy into Baba. This is my thesis. You want to attack the thesis, can. But then it always goes back to, why are you supporting CCP? Oh, this one man, blah, blah, blah. The discussion always morphs back into the same old discussion. It's not attacking with data points on my thesis anymore. That's what I was trying to draw about, like, if y'all get what I'm saying.
No, so my question about investing in stuff like Alibaba, the premise is about mean reversion, that it will go back to the mean. But in the meantime, all the rest of the companies, they are already, I mean, their stock price have already been growing all this while. Like wouldn't it make more sense to rely on companies' growth that are more certain than a mean reversion? Okay, mean reversion is also certain, but we don't know when it will happen. So in a way, it's the same thing, but it's actually not the same thing, right? One is you're betting that it will eventually happen one day. The other thing is that we can see happening in real time, at least for the US stocks.
I think I understand where Kelvin is coming from. I think you are talking about a comparison to many of these US counterparts that are big ones, your Amazon, Microsoft, whatever, right? Yeah. I think also, I do invest in them. It's just that they have a relatively smaller percentage in my portfolio. I'm allocating it based on your own personal investment philosophy. Like I like to find companies that I think have value. Sure, I'm saying some of these US counterparts, when they were going down in 2022, I'm buying them. But it's just that I need time to accumulate also, right? Then suddenly 2023, they all started running up. I think Meta that time was of good value. I mean, the market has proven that it's of good value because they 3x from the bottom. But some of these names, right? Like, I mean, Apple, Microsoft, they are perpetually, or I wouldn't say perpetually overvalued, because when Buffett bought into Apple, it was also facing some sort of problems. Revenue was actually negative. So it's this kind of special situation, or at least you kind of need to know what's that particular investor's thinking or mindset. Like, what's his philosophy? I like to buy companies on the operating table, or like when everybody is saying that these companies cannot make it anymore. That's when I think there is probably some sort of value to be reaped. I'm not saying that companies with good stories ahead, going up and up and up, going to the moon is not a good thing. I mean, Tesla has also shown that investors get to profit very heavily from a growing story and a story that keeps playing out. It's just a different philosophy and mindset and how you look at the markets or how you read it. I'm not saying mine is correct, but I'm practicing my own logic. I hope I'm consistent with my logic. One day, of course, if I think Tesla is greatly undervalued, of the story is impaired, at least it was impaired in 2022. If not, it wouldn't have visited 100. It's just that I didn't have time. It was not my circle of competence. I didn't really understand it. That's why I probably didn't pull the trigger. But you asked me when Tesla was going to 400, would I chase? Probably not. But when Tesla actually cut by 75%, yeah, that was actually a point where people, at least consistent to my philosophy, it's supposed to be where I start considering when a stock is down 60, 70, 80%. I think that's how I can answer your question.
Actually, sorry, Buti.
I just want to respond to Chicken response. I think I recall back my own investing journey, right? I think in the early years, I also have this kind of mindset, same as you, is that we look at the PE, 10 is not enough. We say, let's wait for 7. Then buy at 7, it goes up back to 10 or even 12. Then we sell, make a profit and call it a win. So I also have that kind of mindset, is that we always wanted to buy cheap, and then we always wanted to, profit the buy low, sell high. The sell maybe not so important. The more important one is that you want to enter at a price that's relatively much better than the other people's. So I think that's the main intention. I'm talking about myself. I'm not talking about you. So, and then after some time, I think this kind of mindset also changed. Slowly, I just let myself don't be so obsessed about need to buy cheaper than others, need to look at the drawdown, then only buy. This kind of mindset. I try to just take the price out of the picture and don't even look at the price and just understand the business, because I know that for companies that are doing great, right, the price is definitely something you will look at after. It's just that when you are studying the company, sometimes it is so good that even some premium prices still justify it. So the moment I let go of this kind of really fixated on the price, the valuations, right, I do feel that my returns is getting better. I'm not saying that, okay, maybe this is due to luck or whatever, but sometimes, just have to be humble, I would say. I at least that's my take on my own self, is that be humble. Sometimes you look at the PE is high because market do see something, meaning that the market know more than me. It's just that I don't know how to appreciate it. And if I just take away the price, I just appreciate the business, right? Then I can justify things. And with that, I think it's my investment approach also steer away from need to buy low and just focus on buy the good. So buy the great stuff. That's the transition stuff. I don't know whether this is applicable to everyone. At least this is the journey that I went through.
Eric, you want to make your point first?
Yes, I do. Just now when Kelvin was asking you about his last question, right? Then you were responding okay, this is your journey and how you see it. And then after that, Bunti added on. I thought I was just listening to you guys, right? And I really see that this is a very good analogy to our own life. Don't know whether does it make the cut for this podcast, but it's a
gonna turn into a philosophy.
On your own lane, right? On your own philosophy. People will tell you, hey, be investment banker lah, what big buy property lah, what big buy crypto, what big they will tell you different shining things that have their time to blossom and all that. But sometimes when you're going through the journey, right, your particular peak, your runway, right, your track in life may not be blossoming at the same time as the other investment. Then you start to doubt yourself, oh, am I making the right choice? And did I make the correct decision? Should I cut losses and switch to this more lucrative track and all that? So I think the case in point was e-commerce, right? It used to be the darling of the market. everybody thought that wow, e-commerce has got decades of tailwinds and blah blah blah, things like that. And then data centers, there was a time where REITs, right? I don't know whether you guys remember local REITs, Keppel Data Center or something like that. That REIT was like crazy red hot. No, people would think that, oh, there's no loophole to this story. Everyone needs more and more data centers. So if you are a REIT that just do data centers, right, you sure what big what? Like the runway is like forever into the moon. So that's when the REIT got bidded to very, very high premium. And then I think the yield was barely 3%, things like that. It went nuts. And the story was very attractive, and I know of people who would sell off their boring REIT, those kind Maple Tree those Capital Mall, boring slow 4-5% only. They sell those off. They buy this Keppel, say, wow, what big time. Then after that, we know what happened. The story, don't know, drop until where. Now I think Keppel is not doing as well. Yeah. So I don't know. The boring REITs are still there. They're still churning out their 5-6% as usual. But I think circling back, I really think that what Chiking is doing is true to himself. Like he has this philosophy. He's waiting to see it play out. And I think one day we will see it play out. It's just that we don't know when is it. And when it plays out, it could be very exponential. No one knows. But I think for us, we have our Tesla, right? Yeah, so we're glad to see sometimes it go up, sometimes it comes down. But then that's life. When it comes down, all the people will say, wow, jialat already lah, sell backside already. But yeah, it comes down, it goes up. It's very volatile, but it happens. Yeah, so I thought that's my 2 cents. I
think if I can comment very quickly on this, right? I would say that it's always a trade-off. I think in investing specifically, there are many different philosophies out there. You can do whatever you want. And I think the worry is really the jumping between philosophies. Like some people started off with dividend investing and then they think really, hey, too slow, 3-4% cannot make it. Then I go value investing. Some people start off the Benjamin Graham style, they do deep value. Then deep value already wait for 3-4 years, maybe the thing never play out. Then they'll be like, oh no, this value investing don't work. That's why I go into growth investing. So I'm not saying that those are wrong. It's a self-actualization journey. You see what style suits you best. But I do believe that a certain type of personality or aptitude will fit a certain type of strategy. That's my takeaway. Then on the second part about answering what Bunti was talking about, I think for viewers that are long-time viewers of Backholder, but not viewers of my own channel, right? I think I just wanted to share some of my holdings to let you understand whether I'm really just keep buying low, selling high, or buy lousy companies and when it's cheap, right? So the biggest position, two biggest positions is Baba and Tencent, yes. I do still see them of rather high quality, not the best quality, definitely, but they are of rather high quality as tech companies. And then the rest of my holdings, in no specific order, I'm just going to read them out. Meta Holdings, Amazon, TSMC, Google, Adobe, Estee Lauder. And I have a few Chinese banks that I'm not going to disclose because it's pretty sensitive, this Chinese bank topic. I made a video before. But anyway, I think out of the 7 names, if you take away Chinese banks, I do believe that all of them are good compounders, or at least they've been great as a company. Like for the last decade or so, they had a great run. But it's just that most of them, or if not all of them, had a hit, a narrative change, a story change, financial numbers looking bad, and whatever. So I buy when they're on the operating table, but I make sure that I'm buying a goal. I'm not buying shit that is cheap. I mean, that's at least my perspective. I'm not too sure whether Bunti will agree with me, but I'm afraid that the way he portrays or the way he paints the picture, it feels like, oh, I'm only buying lousy companies at very cheap valuation. Like, I think I wanted to quantify that in terms of the story is changing, but I still believe that many of them are still quality companies. I don't know whether it's true. We'll wait for 10 years to see whether it plays out or not. So when I buy many of these companies, I don't intend to sell them for a very long time unless it gets egregiously overvalued. So even though Meta has I mean, my cost is around 180, now it's close to 300. I'm not selling, even though it's like 50-60%. It doesn't matter to me because I view Meta as a quality company. Unless Meta goes to 1,000 today, maybe I'll consider. But if not, I'm just accumulating companies that have their story impaired in the short term. So that's my investing way or style. And then the last part, I think there is this term called GARP, right? There's GARP investing, growth at reasonable price. That there is this theory of growth at reasonable price. Means you're buying growth companies, but you don't really overpay. So there are actually two more theories that I own self-attached on. So one is called GARP, G-A-R-P. Second one is GAPP. Third one is GAAP. So GARP is growth at reasonable price. GAPP is growth at premium price. GAAP is growth at any price. So I think growth investors very scary when you go to the third scenario, growth at any price. Meaning this is the best, like what Eric talked about, the data center REIT, whatever lah. What's the hot topic in town? AI, 3D printing, whatever nonsense that they had over the last few years. So if I believe that many investors, or at least people that pick growth companies of some sort, I would at least believe that some of my picks are growth companies lah. Like it's not too shabby, 10, 15, 20%, not too bad. They are not your Coca-Cola that grow 2-3%. So it's a trade-off between GARP, reasonable price, GAPP, premium price. So you pick where you want to slide on this what do you call it, slider or on this spectrum. So yeah, I hope I make my point here.
Yeah, just to clarify on the clarification is that I think the challenge is more on like you say, okay, maybe for example, right, Meta, you saw that Meta was very result was very bad some time ago, and then you bought. And then now with all the efficiency things that they're running, Mark Zuckerberg suddenly come up with threads, things are good, results are good. You actually feel better. You think that, okay, I made a right move. I invested into this company. Then the question I ask is that why not you add more? Like why not you just increase your position and you say you already went up by 300 already. So no way I'm going to buy anymore. So that kind of situation where you see the price keep going up and you just I'm willing to buy, and it's very specific reason is the inclination to say I have to buy when it is depressed or the mood is very bad, and you can just miss out investment just like forever just because the price keep going up slowly and slowly. And who knows, right? You are looking at 300 now. It could be 900 5 years later. Right? So you are missing out that part just because of the share price movement, because of your inclinations. I think that's the things that I want to bring up.
Ken, so I think on that point, right? It's not really true. That's when valuation works come in, or at least your own, how you view the company, your optimism, your expectations, your assumptions of the future. So that's my own personal valuation work. On the idea of averaging up, I did. So for Tencent, it went down crazily at 200. I think it was around $200. I kind of caught it at the bottom. It went back up. I averaged up on Tencent actually. So it's not true that I wouldn't. I would if I have. I mean, there are a lot of factors, right? First, you need an income coming in. You need money to even deploy. Secondly, you need to look at the current sentiments of the market. And thirdly, you need to look at the valuations of the company you enter. So it's a myriad of factors. And back to the Meta example, I'm not buying it because it's just a valuation work. I don't see a huge margin of safety. That's why I don't enter. If I have additional capital, I'll enter to other positions. And then, like they said, right, the forest is so big. Why I must be so hard onto one particular company? And it's not like Meta will be the next, I don't know, Apple that goes to 3 trillion. I'm not even confident that they will go to $3 trillion. I don't know whether it will reach or not. I don't want to offend other Meta shareholders, but I'm just thinking that if you are buying at the cheap, there is definitely margin of safety. If the company don't suck. If the company sucks, then it will be a value trap. Simple as that. That's just my logic behind it. But yes, it's not that I don't average up. I did average up. So just to kind of answer that point as well.
Yeah, I think this topic of averaging up is always a bugbear, right? Like always coming back to say, hey, why don't you buy? Why don't you average up? I don't know why I'm looking so blurry, but I think it's time to fade out. Yeah. So Kelvin, you have anything else you want to add?
Nope.
No. Okay. So I'll pass the time to Chiking to do his thing.
Actually, no, I wanted to ask one question for Kelvin.
Okay.
I wanted to ask, I wanted to understand from your perspective the time when you're still all in Tesla, before you keep dollar cost averaging into what, right? Do you feel more comfortable averaging up or averaging down? And are you still averaging up, or I'll presume it's up because your cost price is a lot lower?
I've stopped buying into Tesla since like last year. Was it last year? yeah, sometime last year already. So I wanted to have no, because like previously everyone was trying to get rich, right? I was part of the group lah, trying to get rich group. And I only relied on Tesla. Then this year I realized that I do not have to rely on Tesla. So that's why I've stopped buying into it lor. Then just move it into not move it lah, deploy more cash into like S&P 500. To first do that, you know, that call that what is it called? Core satellite portfolio thing lah. So you have like 70-80% into safe stocks, safe ETFs, then the rest into like this kind of Tesla thing lah. So I wanted to do this style because I knew that I would be able to reach that goal just from my YouTube alone. Not trying to brag lah. Just saying that I'm able to reach that goal without risking all my wealth on just one stock. So I wanted to do it the safe way lah. So that's why I did this.
Assuming that if you're still stock picking, right? Like individually, if you're still
Eventually I will still be stock picking because that's what my channel is about. Kevin Loves Investing. That's my original goal. It's just that right now this 70-80% Tesla thing is hindering me from doing that. It's like I don't have any leeway to increase any more risk in my portfolio because the risk is like maximum already. So I need to lower the risk first. Just to secure my retirement plus my kids' future. Only then I will start looking into other stocks. Yeah. Maybe I might even go into Alibaba one day. Who knows?
you wait for things to turn around first lah. Then I think it's easier to swallow compared to a 70% drawdown. But anyway, I think it kind of did morph a little bit. It started with a China discussion and then it went to individual topics and then it went to finally investment philosophy. But we hope you guys enjoyed the discussion. I think there was this most liked comment on the previous video saying that, oh, seeing how chicken is triggered, I don't even dare to ask questions. The funny thing is I don't know. If you guys really have any burning questions, you can email me, come to my channel and ask me as well. I might make a different episode. But if not, I think this idea of triggering or not, it's just when people are passionate. That's why we speak faster, louder, and I don't know. It in front of the camera, yeah, it looks a little bit different from our normal way of presentation. But don't fear, it's we won't bite you. We can't bite you as well. Yeah, across the screen. So yeah, feel free to ask your questions and we'll see if we can answer them. Yeah, if not, hope you guys enjoyed the discussion and we'll see you in the next video. Goodbye.